Hey everyone, welcome to the MIP Capital Partners Passive Investor Guide. I'm Mark Hart, founder and director of investor relations. And on the video here, we have our CEO and founder, Matthew Sinclair. The Passive Investor Guide is going to be the first place that all investors should go to see if investing in passive investment real estate is a good fit for you and your family. This guide here is going to be a detailed breakdown, ultimately to go over the pros and cons of this type of investment strategy, because there's a lot of different ways that you can invest in real estate, and we want to help you make that decision to see if this is something that fits your overall investment portfolio and is a good fit for you and your family.
And ultimately, this guide is a summary and a great starting point as it reflects basically everything that we've learned and then been able to condense into a short guide. Basically, the things that we wish that we knew when we first started years ago, we've put in this place for an efficient way for an individual to basically initiate the process of finding an appropriate financial sponsor to potentially partner with.
Absolutely. Yeah, and there's a lot of books, that we've read and we can recommend to you guys as well to read, but we feel that this guide here is essentially the summation of, what we've learned throughout our decades of experience and, putting it and condensing it all into, ultimately one location here. So from a high level executive summary, investing passively and investing in real estate can provide a fantastic source of income, appreciation, wealth creation, and tax benefits. But ultimately, it's all about being able to execute, right? And focusing on who are you going to partner with to build out that team. Because as you know, when investing in real estate, you're creating your own business, right? And you need to be an expert in the different markets, the different strategies. Got to build a full team out across the board, lenders, everything from, inspectors, the construction teams to the property managers. Well, as a passive investor, that's where you can come in and partner with essentially sponsors or general partners, such as ourselves, and ultimately rely on our expertise, right? Rely on our knowledge. So it can be more hands-off for you as the investor. So you can focus more time on your career, on your family, on your hobbies, and treat it more as if you are buying a stock or a REIT, but you get significantly more benefits going through this passive investment strategy.
And we've broken down the process of evaluating a passive investment into what we're calling a passive investment evaluation framework, just basically taking the various subcomponents and then diving deep into each of them, kind of walking an individual through, the process of understanding why it would make sense to be a passive real estate investor and what specifically passive real estate investing is, and then all the way through from the risks, vetting financial sponsors, tax attributes, and so forth, and then even the key deal documents. I think initially it can be quite overwhelming when you're evaluating one of these investments because there's just many different aspects to go through and due diligence on and to understand. I think condensing everything into a simple document that a person can walk through and then having a framework to apply to any investment that comes up is just, in my mind, a very efficient way to approach the puzzle.
Absolutely. One of the first points that we're going to dive into is the high level definition of what passive investing real estate is, and essentially what is your role and responsibility in this partnership. As a passive investor, you're going to be what's called a limited partner or an LP. You are essentially partnering with the general partner, the GP, or the sponsor, which is us. And you are going to essentially have a significantly different level of essentially control, risk profile, time involvement than with other types of real estate investing. And that's what this is going to dive into.
I think there is sometimes a misconception in real estate investing that it is easy. And I would say that if it's done properly, it is anything but. It needs to be done in an extremely rigorous way, and that is going to take a lot of time and requires a lot of expertise. Every aspect of every deal needs to be completely diligenced. And that goes everything from specific submarket selection to the properties themselves, negotiating contracts, inspections, insurance, property taxes, financing. All of these things require a lot of experience and expertise because the downside of being wrong in any one area could be significant. And so we really pride ourselves on doing great work. And I think that a benefit to passive investors is that you're getting the benefits of the many decades of experience and specialized knowledge that different GP team members have spent their careers building. And it can be a very efficient, from a cost and tax perspective, way for limited partners to access this expertise. Another key component is scale. Through passive investments, limited partners can get access to scaled investments that would very rarely be open to any given individual. And so you get, just through economies of scale alone, the economics tend to be quite a bit better.
Absolutely. Now, diving into real estate as a whole, right, there is a lot of risks. There's a lot of uncertainty. And ultimately, you can go down that path on your own, right? And, it's something that we love to do, right? We love real estate. That's why we live and breathe it, every single day. But ultimately, that takes a significant amount of time, and you need to have a lot of experience to be able to produce a, quality return on investment. And so diving into all of those different types of risks and uncertainty, those are going to be mitigated as a passive investor for yourself, being the limited partner, because you get to partner with us and get the benefit of having all of that experience by being a partner of ours, while you do not have to have that kind of day-to-day involvement, or more involvement that you would have if you were a direct owner.
And some of the things that make real estate a very lucrative investment to make, potentially, some of those factors, which we've listed on the left side of this page, represent certain forms of market inefficiency that also represent risks and uncertainty. And so a lot of people will only tell you about their good investments, but there is downside to real estate investing. And it's our full-time jobs to basically be diligencing every aspect of the business to try to mitigate risk to the greatest extent that we can. And part of why real estate has been such a lucrative business to be in, and why it's arguably the single best asset class in the long run through which to create wealth, is because there is this degree of inefficiency. But as I said, that is also a double-edged sword where there's additional risk there. And so just the fact that it's not as transparent, it's somewhat opaque, it's illiquid, there's a lot of idiosyncratic knowledge in any one market, any one building type. No two buildings are the same. So the valuation of single-family rental properties, for example, can be quite a subjective exercise. Negotiation can be a large factor. So it is an area where a skilled and experienced, dedicated financial sponsor can add a lot of value relative to the risk taken to achieve the given return. But it is also an area where people can face losses if they're not diligent or not full-time professionals. So I think it is an area with tons of upside, but one needs to be very diligent and careful.
Now, one of the biggest decisions that you are going to need to make when you decide to become a real estate investor is, do you want to take direct ownership? Meaning, do you want to take title to the asset yourself? Do you want to buy it? Do you want to be involved in any kind of renovations? Do you want to be involved in the ongoing property management? Or would you like to focus on the passive real estate investing side, where you are essentially giving up your control, right? You are staying hands off. You're ultimately saying that you're not an expert in real estate. You're not an expert in the market. You're not an expert in the space, but you want to partner with those that are. And then you get all of the experience and the benefits of your sponsor. And if you do proper due diligence on your sponsor, and the sponsor has a significant amount of experience, that can give you some quality risk adjusted returns.
I think a key thing that a lot of people overlook is that when you invest in a quality structured passive investment through a reputable financial sponsor, you're getting access to something that is at scale. And at least in the case of a diversified portfolio of new construction, single family rentals, assuming they're in the right suburban markets where demographic trends and population growth are favorable, school quality and so forth, you can have a consistency and predictability of cash flow that facilitates consistent distributions that you can plan on. And I say that because oftentimes with individual property ownership, or even in a syndication where it's just sort of one apartment building or one office building, the idiosyncratic risks associated with that one building can cause large fluctuations in cash flows. Whereas if you have a large pool diversified across a portfolio of single family rentals, for example, the idiosyncratic risks associated with any one property, any one single tenant concentration risk of any one property becomes nullified through a large enough pool. In all of our funds, we do the math and ensure that they are in fact large enough to be diversified pools, such that no one issue with a property could disrupt the distributions. And I think that's something we're really proud of. We have a long track record of paying distributions on time and at the level that we've told investors that we would. And that is actually rather difficult to do with any one single asset.
Now, we are going to break down the different risk spectrum of real estate investing, as the different kind of asset classes that you can invest in should produce a certain return on investment for the investors. And essentially what's really important to know is that it all comes down to your risk adjusted type of return. A lot of the different deals that you're going to see out there are going to be these value add style deals, which are going to have a significant amount of risk associated with doing renovations on the assets, as they want to stabilize those assets, turn them over, increase the value by increasing the rents, doing that through large renovations. But unfortunately with that strategy is that you're trying to predict the future. Essentially, these renovations, as you know, we have a lot of experience with them, they take multiple years to play out. That business model of renovating or repurposing a multifamily asset, you have to wait for the tenants to leave, right? And they're on long-term year-plus leases there. So we're talking multiple years in the future, and it's just essentially risky to predict that future. So for MIP Capital Partner, we focus on removing that type of risk, but getting you a very similar type of return on investment through the way that we have basically built this portfolio. And that way you get essentially the best of both worlds and can get an increased return for taking significantly less risk. And that is one of the reasons why we are focusing on this investment strategy and have created these vehicles for investors.
Yeah, I think the key thing, and what in many markets that one would argue are relatively efficient, like a publicly traded stock market and so forth, where all known information is reflected in current stock prices, in such markets, it is extremely difficult, if not impossible in the long run, to achieve a degree of return in excess of your risk taken. But with real estate, at least at the local level, it is possible, and certainly we're in business to achieve, a degree of return that is in excess of risk taken. And so over the long run, with a focus on capital preservation, we're able to compound returns to the benefit of investors without really risking principal at all. And I think that's something we're very proud of, and that's we designed our entire investment strategy and firm around that concept.
Now, one of the most important roles as the limited partner or the investor, essentially your role is making sure you do a deep dive on the actual sponsor, the person that is going to be the general partner, and ultimately the group that you are partnering with. Because it doesn't matter if you invest in the best market, buy the best assets. Ultimately, what we feel is the most important aspect of any deal is going to be, well, who are the sponsors? What is their track record? What type of experience do they have? And essentially, what type of communication do they have for you as the passive investor? And if you put all of that together, that's where you can get those increased returns, basically above your risk profile. However, it's really important to do that deep dive on the sponsor and have those answers to those questions.
I think a point on vertical integration is key. I'd say, just from experience, having seen the use of both vertically integrated systems and external property managers through my career in private equity, I think having the benefit of vertical integration is a real competitive advantage that we have. Like, I can attest to it because on a daily basis, I have personal access to the top decision makers at what is a very large property management company in Reedy & Co. And so that helps us really gain insight into what tenants are looking for, how rents are tracking versus forecast, and so forth. And I think not having that would relinquish a degree of operational control such that we wouldn't be able to be proactive in case any issues arose. So that's one point here that I'd like to point out when conducting due diligence in a financial sponsor. I think the vertical integration point specifically with property management is integral to the long run success, I think, of any financial sponsor.
Next is going to be understanding the different type of transaction structures. Essentially, what are the different types of deals that you can invest in? High level, these are going to be under the Regulation D ruling, which is going to be a 506B or a 506C. Both of those have different types of, essentially, pros and cons, and you can be reached by the sponsor depending on what type of deal it is. So that's one of the most important questions to ask, is essentially what type of deal are you investing in? And then coming up next is going to be the 1031 exchange compatibility, because not all deals are you allowed to do a 1031 exchange. And that has to be written into the legal docs on the very front end. And essentially here at MIP Capital Partners, we've been able to structure our opportunities for the current, Fund 3 and beyond, to be able to allow the opportunity to have a 1031 exchange, because that obviously lets you compound your growth for the long term. And that's what we're really here to do, have those long-term investments that you can, pass on to your children or continue to ride out for decades to come.
And 1031 exchange is a highly advantageous approach that I think I would just say the caveat being one needs to plan well in advance in order to be able to successfully execute a 1031. I think, Mark, you'd agree that's the big thing, getting out in front of it.
All right, next are some key terminology that's really important to the passive investor, because ultimately this is how you're going to get paid. The first terminology, you're going to see preferred return, right? This is a way that the passive investor can get paid first before the sponsor gets paid, right? Showing that the sponsor has a high degree of certainty in the execution of their business plan. Next is going to be the return of capital before sponsor splits. Essentially making sure that the passive investor gets their entire original investment or principal back before splitting that with the sponsor. And what's really important to know as a new investor is that all of these deals can be structured differently. right? There is no one size fits all in this world of passive investing. That's why it's really important to know how the deal that you are analyzing differs and understand where these terminologies, how this falls on the particular deal that you're looking at, because they can vary from deal to deal, from sponsor to sponsor. So it's very good to know, what these mean.
I would say the key thing here, it's important to spend the time from the perspective of a passive investor to ensure that when you're evaluating a potential passive investment, that the profit splits and the way the return of capital before sponsor profits, the way that's calculated, that it is to the benefit of investors. There are certain structures out there that are probably in favor of the general partner more than they would be at the institutional level, say. And I just think it's the key thing to make sure that LPs are being treated fairly.
Next is going to be the deal analysis, right? Focusing on the individual asset and making sure that you have a comprehensive underwriting plan. And this is something where individuals spend their entire lifetime underwriting deals and becoming an expert at that. And that's something that Matt truly is an expert on. But when you guys are focusing on trying to decide if an investment is a good opportunity for you or not, a lot of the different pieces of data can be hard to find or hard to access throughout the real estate investing ecosystem, essentially. So as a passive investor, there's going to be some documentation that the GPs and the sponsors will provide. And in that documentation gives you access to that data. And that data should be able to help you make an educated decision to see if this is a good investment or not.
So a common factor among the most successful publicly traded companies that I had the pleasure of working with through my career as an investment banker, the common factor among them and then the best private equity firms, they have a very, very clearly articulated buy box. They're very, very specific about what they look for, and they're a little bit rigid in adhering to a rules-based funnel system. A benefit of specialization, especially within real estate, is one gains the benefit of pattern recognition. So if you were looking at a very similar type of asset over time and your markets inside and out, you can quickly discern between good opportunities and bad. And the vast majority of assets that we look at, for example, do not fit our criteria. And so I think it's critical for anyone, whether you're professionally doing this or just as an individual, to create a funnel system, and you start with a fairly wide number of assets you're looking at and then narrow it down to the point where for every one investment that you ultimately go forward with, there might be 10 to 20 that you initially consider. I think it's certainly worth the time doing. It's worthwhile to avoid the bad investments. I think that overall, if you think about what drives returns over time, it's often avoiding mistakes that is the single best thing an investor can do for him or herself.
Next up is going to be the tax benefits gained through passive real estate investing. There has been, as of this year, 2025, the tax laws have changed, which are going to allow 100% bonus depreciation. And ultimately, that is a massive deal from an underwriting and a math perspective, essentially giving a significantly increased return to investors. And this is something that has just changed this year in 2025. And it's really important to note that as a passive investor, you might not always get the tax benefits because there's different types of structures out there. However, that's why it's really important to ask those questions to understand, are you going to get those tax benefits? What type of tax benefits are you going to get? Because it can vary dramatically.
And I think certain updates to legislation, which was just released in July of 2025, have significantly increased the time value of money of pursuing these tax benefits. the permanent 100% bonus depreciation has quite a significant impact. I was struck at the degree of impact that it had in a beneficial sense to the math. And so it's something that is in the interest of individuals to pursue. I would say the caveat is it needs to be done very, very specifically and by subject matter experts. This is not something that, at least I would recommend, that an individual pursue on his or her own. It's not something that you'd ever want to be offside on. But if done correctly, you are not incurring risk to receive what are quite significant time value money benefits from this tax depreciation.
Absolutely. And the passive investors, y'all are going to be receiving a K1, and on that K1, the investment is predicted to have these passive losses, which can be used to offset the passive income. And then if you are a real estate professional status, an REP status, right, you're in the real estate investment space, then you can use that to offset your active income, even if you file your taxes jointly. So these are, terminologies that I highly recommend, that you look into. Ultimately, one of the best strategies out there, that you can do is you have the high income earner, and then as a W-2, and then the significant other is able to qualify as a real estate professional status. So since you file your taxes jointly, that allows you to make the investment, take the losses, use those passive losses against your active income, and that dramatically lowers your adjusted gross income and can save you, thousands of dollars, at the end of the year. It's ultimately how, we personally file our taxes, and ultimately they're one of the big powers of investing in real estate is that the tax benefits alone can be worthy enough of making an investment. And especially now with the new legislation, that's in place. All right. As a passive investor, you're going to see multiple documents, right? And it's good to understand what those are and what those mean. These documents are essentially going to tell you the story. They should give you all the details that you need to make an educated decision. They will be drafted by the sponsor and their attorneys. And ultimately, everything should be accompanied through these different types of documents. And ultimately, at the very end, is going to be the contract or the subscription agreement, which, as the passive investor, is what you'll be signing to make your investment there. So going through these in full, understanding that these documents from a private placement memorandum and an operating agreement, it can be like a painting. Ultimately, they can all be very different, right? And understanding the terminology is really important because how they differ can adjust your risk profile of the actual investment. That's why it's not always best to just look at the top line returns. It's really important to understand what the deal structure is, what the flow of capital actually is. When do you as an investor get your return of capital back? At what point in the cycle? It's all different. And by diving into this passive investor guide, it'll explain that.
I think a point on the investment summaries, which can be called some different things, is basically the presentation or document that the financial sponsor puts together as a marketing document to discuss the various pertinent points about the investment. It should be in sufficient detail that a person can really completely understand what the drivers and assumptions are underpinning the investment. I find, not to be critical, but I do find that a lot of the investor presentations that I receive arrive at high level numbers without really substantiating in specific or sufficient detail how they're arrived at. And so to me, I would want to know everything that underpins any given number, because assumptions can have enormous effects on the outcome. And so taking face value financial results such as an IRR or multiple invested capital, taking those things literally without understanding exactly what the underpinning drivers are, I think that is something to avoid as a passive investor.
All right. And finally, building out your financial sponsor network here, it's for us, these are long-term investments. We are here to build long-term relationships with our investors, something that you can create generational wealth, something that you can pass on to your children, right? Quality assets, quality long-term investments. And because of that, we want to make long-term relationships. So at the bottom here is a link. You can book a call, with myself. We would love to have our investors come visit us at our office here in Tennessee as well. Ultimately, most of our clients we've never met in person because that's why they want to be passive investors, because they don't have the time to put the team together to pull off this type of investing strategy, which, as everyone knows, is very time intensive. So being able to partner with us, create those relationships, something that we really hope to do with you.
And something that we're proud of. We take a lot of professional pride in the fact that a lot of our investors are repeat investors across different investment vehicles that we've done over time. And I think that's a very good sign and something that we're hoping to continue with.
Absolutely. So that's it for the overview of the Passive Investor Guide. If you would like to receive a copy of the Passive Investor Guide, we will add the link here below this video here. If you want to reach out to us personally, we can also send that to you as well. Please visit our website at mipcapitalpartners.com. And hey, hope to hear from you soon. Thanks, everyone.
Thank you.